Basically, we last time we talked, we had our early November correction over signal. We were getting some good rally off of it. We basically said that was likely to last into year end. As we got into year end, we continued to rally. We got to kind of valuation levels. We got to levels of futures markets discounting rate cuts at certain times and of a certain size. And we started to talk about in our daily services about how Marco's just getting ahead of itself. It was basically, and we'll talk about what the narrative status is now, but basically the market was pretty much 100% confident there wasn't going to be any kind of significant slowdown in economic growth. They were 70% confident that we were going to get a first rate cut by March 20th, and we were going to get a total of 6 rate cuts throughout the year. And that's pretty aggressively optimistic. It's not impossible, but it's quite aggressively optimistic. Just to give you an idea, we've never had 6 rate cuts following a series of rate hikes without a recession since World War II. So the market is anticipating almost no slowdown in growth and the 6 rate cuts, which means they're really anticipating inflation to fall very sharply and below 3% really quickly to allow the Fed to have, first of all, very quickly be able to cut interest rates by March and then just keep cutting them. So the degree of assumptions there are pretty aggressive. So it's quite possible we're going to have some backing and filling and further correction possible a little bit ahead. So we just want to keep that in mind. Right now, the narrative, basically is that there's still 64% odds of a March 20 rate cut built into futures markets. The expectations are that means swift, continued disinflation below 3% on almost everything that would allow the Fed to do that. They're still expecting very close to 6 rate cuts throughout 2024, a soft landing, so there's nearly no further decrease in economic growth throughout 2024. And bottoms-up earnings analysts are anticipating somewhere between 11 and 12% earnings growth in 2024, which is about double the average, on the back of AI expected to substantially boost big cap earnings along with strong economic growth. Those are optimistic on every front. And so it's not impossible if we get proof of some of these theses, the market can continue to rally. Well, certainly it's due a period of digesting the 17% gain off the late October lows here in the first quarter. But a lot of those assumptions and that narrative is very aggressive. So what I would say is that we certainly didn't have anything that the main points of that, we'll call it a medium term. I'm not even going to call it intermediate term. I'm not sure it's going to last all year, but it's longer than short term. So we'll call it a medium term rally off the October lows with growth continuing and inflation trending lower. And at some point in the year, probably before mid-year, the Fed's starting to pivot to easing. As long as we're in that rough ballpark, that rally off those October lows, medium term is still kind of the main trend. We're potentially correcting short term, kind of going back and forth. We've got some things for you to look at to see whether we're going to correct further. But really, unless we really support all these narrative theses, I think we're going to have trouble still breaking through the same resistance we were talking about at the end of the year, this 4820 level in the S&P that's all-time highs from 2021. So I think that's going to be difficult if we get more data that kind of doesn't support some of this narrative. I think we can decline in the first really strong support. You can kind of see an HVN here weekly. There's one daily as well. This 4,500, 4,600 level that was from the July highs. That's really kind of a decent target for the type of action that we're seeing in the correction so far. So we're kind of watching things. If we get sort of strong move up with strong volume traction, and we start to get Thursday, we really have important data with the CPI data that all supports the thesis. And we start looking like we got renewed volume traction, renewed breadth, et cetera. We can still keep going, but it's probable that we're going to be digesting these gains for a while. One of the reasons that we're digesting gains in a key market really to watch, as it has been really for much of the year, is the TNX interest rates. You can see in a very steep downtrend that helped support that Santa Claus rally. But at the end of December, December 28th, same day the S&P peaked, the rates bottom and we started up and we kind of broke through that very steep downtrend line. And at the end of the week, we closed above 4%, which a lot of people were kind of concerned about. There's really significant, this 4.091 level is really a significant level. And it's kind of held things multiple times, big highs here, lows, and then the breakdown. So if we close up through that, that's probably going to be problematic for stocks short term. And the real level to watch for a more major correction would be this 4.4%, 4.3 to 4.4% resistance zone. We get through that, we've really got problems with interest rates again. Now that could happen because of inflation, or it could happen because of the problems with supply of bonds that we've talked about before. We still have a ton of supply of bonds that have to be put out in the market, auctioned off this year. And the Treasury is talking about potentially taking the money that they stole from the Russian central bank. So Russian central bank, like any central bank, some of its reserve assets were US dollar denominated assets, including T-bonds. So it had hundreds of millions of dollars of T-bonds as its reserve assets. All T-bonds are held in the US on the back of all foreign central banks. And so what the US did that was a first real problem for the dollar is it seized those assets. As soon as the Russians sort of invaded Ukraine, the US seized those treasury bonds and all the dollar assets and stole the central bank assets of the Russian people. Now, what they're thinking of doing is selling those bonds and using the proceeds to fund arms to Ukraine. Now, think about this that sounds like a brilliant plan in some vein of thought, but if you think about this you're a foreign central banker, that's essentially a default. Here's a central bank that legally bought treasury bond assets as their central bank assets for their people. First of all, the fact that the US seizes it is illegal internationally, and that's something that's really had problems since 2022, why we have the BRICS Plus and people trying to get out of the dollar so strongly. But if they're now selling off those assets that still belong to the Russian people, if they sell those off and use them to arm their enemies, think about how likely are you going to be to want to buy T-bonds if you're a foreign central banker? It just means that buying T-bonds means that the US doesn't like your policy. It can seize the assets and then use those assets of your people against you. That's just insane. So there's a possibility, if that policy goes through, that we could have a more substantial run on the dollar and on treasury assets that would lead to higher rates. It's probably not going to happen. I think it would be an insane policy, but they're talking about it like they're really going to do it. So we have to watch the dollar and we have to watch TNX rates, and the thing above 4.4 would be really a major problem. The other thing that we've had since the beginning of the year is we've had some inflation data that's a little bit not coming down as sharply, and we've had some growth data that's questionable, and we've had the job market that still looks pretty hot. All those things have led to this rally from 3.8 to 4.1% in TNX. We really have to watch that it doesn't get much further. The other thing now that I would say we also need to watch, if you look beyond the headline number and you go to the household survey of employment, it showed the biggest drop in employment in 8 months, 638,000. That's a huge drop in employment. So it's weird. We've got a headline number that was up sharply. We've got a headline number that's diverging sharply from that. And then we got the ISM service PMI. ISM services have been the real strength. As you remember, manufacturing's been essentially in a recession for a year. ISM services have been the things that have really been holding things up. We had a very sharp drop in the services PMI, and it showed really weak employment and really weak new orders, which means it's likely to remain weak. That new orders kind of tell you what's happening in the future. So we kind of also have to watch, because we're in this Goldilocks scenario, have to watch for a sub 50 reading on the services PMI. Sub 50 readings for 1 month tend to correlate really highly with recession, and for 2 months in a row have 100% correlation with recession since World War II. So really want to watch. We're now at 50.6. That's not that far from a sub 50 reading. So want to pay attention to services PMI data as well. We could start getting this situation where the market starts to be concerned about a slowdown more than it currently is, which is almost none. All right, so we had short-term sell signals in our models. We could get a buy signal at any time off of that. We haven't gotten to oversold levels. We never got, so for example, the McClellan oscillator, McClellan volume oscillator, last time we were talking, we said, really would like to see the Nice-McClellan oscillator get to above plus 300, and or the Nice-McClellan volume oscillator getting above plus 100. Those are things that tend to indicate a more sustainable move underway. Did not get those. And then we got a sell signal in both of those indicators. I would watch things like, we're going to be watching the NYHL, which is a net new highs, new lows. That going below zero would be a sign that things are really deteriorating more, and you're likely to get that decline to test that 4,500, 4,600 support. The thing to realize is in an election year, it's actually more common than not, 60% at the time, you get some kind of a correction in the first quarter. That's just really common. Unlike the normal seasonality in pre-election years, you tend to get that decline early and get a rally, and then start worrying about the election. There have been a lot of positive technical internal developments. The internals are relatively strong. Small caps and mid caps did pick up relative strength quite a bit during the rally, broadening from the Mag 7. When the rally started, it was just the Mag 7. But small cap IWM really wasn't able to close. So you look here, you really want to always look for the last sort of big high that led to new lows. And that's the sort of this 208 level in IWM. That's really, even though you've got kind of a lower base, this is the base that you really want to break out of to clearly suggest you're on an uptrend again. We weren't able to do that. We've gotten volume traction off of that. So yes, small caps, and if you look at the relative strength versus the S&P, yes, it did pop above a very steep downtrend line, but it also hit a downtrend channel and backed off. Really kind of need for IWM and small caps to break out above these March 2022 levels, and for this relative strength to break out above that downtrend channel to suggest that we're really clearly seeing a change in breadth.